What's going on, guys? Back with another one, an update to our video from yesterday around the bank run at Silicon Valley Bank. It has just gotten crazier and crazier. And so just briefly to bring you up to speed in terms of the background for this is that earlier in the week, we obviously saw the decision to orderly wind down Silvergate Bank. Silvergate was much beleaguered. It was a crypto bank and had been through a big bank run because of all the chaos in the crypto industry. Wasn't really initially about the solvency questions of Silvergate itself. It was much more about the industry just kind of fleeing from itself. But ultimately, Silvergate decided to shut down this week. We had senators like Elizabeth Warren cheering it on in a kind of very schadenfreude-y way. And at the same time, something was brewing in Silicon Valley Bank. Now, Silicon Valley Bank shares with Silvergate a concentration in a kind of high-tech space. Silicon Valley Bank has been the tech companies, the tech industry's bank for a long time, really since they started in 1983. I was in Silicon Valley for about a decade, and Silicon Valley Bank was just where companies banked. It was where our startups banked. It was where our VC funds banked. It was sort of integral and integrated into that community. And interestingly, what happened is that over the last few months, Silicon Valley Bank has had to sell assets that it bought when interest rates were low at lower than their book value, because as interest rate prices or interest rates have gone up, the ability for companies to go out and get risk-free treasuries has gone up, and that has caused the price of all other bonds and all other assets that the types that banks hold to go down, which isn't an issue unless you have to sell them. Turns out Silicon Valley Bank had to sell them. They sold about $21 billion of the assets that they had purchased over the last couple of years, realizing a $1.8 billion loss. And we're looking to raise, we learned this all this week, $2.25 billion new dollars. That really spooked and surprised markets, who not only didn't think or didn't expect Silicon Valley Bank to have to go raise, they didn't expect them to have even sold these assets. Now, this was all made much, much worse by one of the world's worst crisis communication strategy that I've ever seen, in which the CEO of Silicon Valley Bank basically said, "Don't panic, stay calm, and this is only a problem if everyone starts saying it's a problem," which is the most self-fulfilling prophecy that I've ever heard. With all of that happening, this was all just yesterday, the tech industry started getting really nervous and started running for the hills. Now, there's been a lot of debates and back and forth about this, about whether VCs should have encouraged their companies to stay put because this was just encouraging a run on the bank. Some have even suggested that people like Peter Thiel were just trying to give their neobank portfolio companies a leg up. I don't really know. I do think that in the world where everyone can remain calm, bank runs don't happen. But the damnable thing about bank runs is that that's not the world that we live in. And when you're a company or an individual that has a fiduciary responsibility, such as a founder and CEO of a startup company, if there's a possibility that your bank is going to go out of business because of a bank run, your job is to try to get your money out of that bank, even if you doing so makes that bank run scenario more likely. It's a prisoner's dilemma, obviously, and ultimately the people who thought that it was going to fail were correct. This morning, we woke up to the markets just absolutely trashing Silicon Valley Bank stock overnight. It was down something like 60% overnight, just a huge, unbelievable downward candle. And in the morning, everyone was basically talking about what it meant and was there going to be a white knight buyer coming in. People were talking about JP Morgan, who might want to get their hands on the incredibly exciting tech companies in there from a customer base perspective. But it wasn't just Silicon Valley Bank that was struggling. A huge number of banks, First Republic was down 45% at one point. Signature Bank, which has been associated with Silvergate and crypto, was down 22% or something like that. You can see on TradingView the numbers, the downward price of these assets over the course of the week. And so the conversation was already brewing about whether this was a larger banking crisis. And then right around noon East Coast time, something happened that basically no one that I was watching or observing thought was going to happen, at least not this fast, which was that California regulators shut Silicon Valley Bank down. They put it into FDIC receivership, and that was that. It ended up being the second biggest bank failure in American history in terms of the assets under management at the time of failure, just behind Washington Mutual. Now, obviously, there were other bigger financial institutions that failed during the global financial crisis or that were not allowed to fail, right? Too big to fail. But it's still a huge deal. This was somewhere between the 16th and 18th biggest bank in America. And more than that, it was incredibly closely aligned with one of the most important global advantages from a technology, from an economic, from a geostrategic perspective. One of the most important industries that America has that is the envy of the world, which is our startup industry. That is just that whole industry right now is absolutely reeling, trying to figure out what's going on. And I thought Brad Hargreaves, who was the founder of General Assembly and a number of other startups, did a really good job of pointing out why. He said it's not just a dominant player in tech, but highly integrated. He talked about how it was integrated in the lives of founders who often had their personal mortgages in. He talked about how Silicon Valley Bank was a huge lender to startups. And one of the preconditions for those loans was often that they had to bank with Silicon Valley Bank. And so yesterday, CEOs who had loans with Silicon Valley Bank either had to basically pull deposits and default on that venture debt or risk losing everything. And because it was so unthinkable, they just decided to hold tight. Now they're in a position of not knowing if they're going to be able to get their money out or what percentage of their money they're going to have. And this is just an enormous problem. You're seeing it in images from Silicon Valley right now where startup founders are lining up around the block to try to get whatever they can, but it's not looking good for them. The FDIC has said that they'll get the $250,000 that they're insured for on Monday, but after that, it's going to be based on when they can sell assets and for how much. And so the startup world is just reeling right now and doesn't know what's next. And I think that all on its own would be a huge problem. You have representatives from California trying to figure that out, saying if depositors lose confidence on the safety of their deposits over $250K, we're in trouble, even though that's exactly what the FDIC is there for. And in the tech industry, I think you really do have this potential where for this entire generation of startups, winners and losers are chosen, at least in part, by the randomness of whether they banked with Silicon Valley Bank and whether they were able to get their money out literally yesterday, which is just absolutely insane. Of course, it's not just the startup world that people are concerned with. The question is whether this will be endemic to the rest of the banking world. And the reason that it's a problem, the reason that people aren't just writing this off as an issue of crypto or technology or one of these industries that a bank has high concentration to, is that the fundamental underlying issue wasn't the impairment of those industries. It was the fact that all of these banks, and it wasn't just these two banks, loaded up with long duration securities, mortgage-backed securities or long-dated bonds that don't align well with a run on the bank. They loaded up on those long-dated bonds because in a zero interest rate environment, going longer duration was the only way for them to get yield. They had to move farther and farther out on the duration spectrum to get farther and farther out on the yield curve to enable their net interest margins. And the situation changed radically when the Fed underwent the tightest, fastest hiking cycle in 40 years. All of a sudden, all those long-dated bonds were completely underwater and worth much less than when they had been purchased, which could have been fine had they been allowed to mature, but they weren't in the context of a bank run. And the issue, and the thing that every regulator in America should be worried about right now, is whether that fear that all these other banks are going to be in that same position creates a self-fulfilling prophecy that has people calling up their banks, pulling their assets as well, which is going to then cause more banks to have to go through the same process of prematurely selling assets, which are long duration. And you get the point. This is a self-reinforcing reflexive cycle that ends in absolute chaos. You already have folks like I saw Preston Byrne talking about how the economy is going to need another bailout, basically another TARP, because this is a situation of the Fed's own making. I'll bring it up as we talk more. You have other folks talking about how the extent to which this is the Fed's problem is just, it makes it unique. So anyways, I think it's a really unique and difficult situation, but one which is entirely kind of the Fed's own making. So yeah, here's Preston's piece. If the Treasury knew what they were up against, they'd have emergency legislation in front of Congress tonight, and they'd enact it before Monday. If other banks are exposed to mortgage-backed securities the same way SVB was, they need to provide bridge financing to get them through high inflation, TARP 2. It's the exact same thing as 2008, only instead of terrible lending practices, it's Fed policy which is eroding the value of the bonds on bank books. The government created this problem. And by the way, this goes back to exactly what I said in a tweet this morning. I basically said that the only reason that people aren't angrier at the Fed right now for causing a banking crisis with this incredibly fast tightening cycle is that people don't like crypto and tech. They just plain don't like crypto and tech. And so they're easy punching bags. But at some point, and that's already happening, the anger is going to shift. And when it does, it is going to be righteous. This is the break that the Fed feared. It is here. And the only thing to do now is to get through it somehow, some way. Balaji Srinivasan said, the Fed said till December 21st that in 21 that inflation was transitory. They let banks buy bonds with customer deposits. Then they suddenly hiked rates to decadal highs. The bonds they sold got less valuable overnight. Anyone who trusted the Fed got wrecked, and now so did their customers. We have not heard the end of this story. I don't know where it ends, but I know that it is not good going into this weekend. And you guys, if you pay attention to me, you know that I am not an alarmist, but I think that we have real serious issues here. And I think that the government does have to figure out how to calm markets because they do not look calm to me right now. And I think that the question of to what extent banks are actually underwater with unrealized losses just got a whole lot more acute. Anyways, guys, I will keep you abreast of any new changes over the weekend to the extent that I see them. For now, I appreciate you hanging out and checking out the content. I will talk to you soon. Peace.